And we are back. We are the Coalition, loud and proud, outrage porn free, civilly disobedient media, broadcasting live on the worldwide Coalition Media Network, here at the Go Local Live Broadcasting Center, in the heart of the city we love, Providence, Rhode Island, the naked city, the city of 1,000 stories. We just told a very provocative one. Good friend of the show and someone that I'm proud to call a personal friend, Representative Bob Lancia, talking about energy rates, talking about, well, any one of the numbers of issues bedeviling the great state of Rhode Island as we stagger towards our inevitable financial collapse and in the run-up to the next legislative session. This hour, we want to get right to it. I have the unique privilege of introducing someone for the very first time who's taken the time to dial in on what got to be one of the most hectic nights of the year for him. He is Joseph Bishop-Henchman. He is the Executive Vice President and Attorney at the Tax Foundation. He analyzes state tax trends, constitutional issues, tax law developments. Joe has testified and presented to officials, and by the way, I'm reading from his official biography. You can find this on his website. In 36 states, including, we're going to talk about briefly the Rhode Island connection, testified before Congress 6 times, and has written over 75 major studies on tax policy. He holds a law degree from George Washington University and a bachelor's degree in political science from Cal Berkeley, a minor in public policy. He was identified as among 4 people who will likely dominate the field of taxation in the next 10 years. It's astonishing the breadth of his coverage. He's been in the Wall Street Journal, USA Today, the Washington Post, Los Angeles Times, the Baltimore Sun, the Orange County Register, the Philly Inquirer, the Christian Science Monitor, ABC, NBC, NPR, and now somehow he's managed, despite being on Barron's, Kiplinger, Forbes, Fortune, he has deigned to join us here at the Coalition Talk Radio. Joe Bishop-Henchman, welcome to the Coalition for the very first time.
Thank you so much, and certainly not deigned. I'm a big fan of the Coalition, and it's a great honor for me to be able to be with you. It is a busy night, but we're just kind of watching the Senate right now, waiting for some developments. So I'm happy to be able to do something a little productive for a few minutes.
Absolutely. Well, first of all, let's. There is a Rhode Island connection here, from what I understand. You were involved in some Rhode Island attempts at tax reform, I think, back here in the day at some level.
Yeah, it's actually been ongoing too. I don't know if this is news for you, but Rhode Island doesn't have that great of a tax system. It's kind of had very high individual income taxes, not very good unemployment insurance taxes, pretty high property taxes, and the sales tax is one of the highest in the country. So we worked with, back when Governor Kucheri was in office, and with the legislators at that time to lower what at that time was a very high top individual income tax rate, over 9%, and get it down quite a bit. It took a couple of years and took a lot of work with some very good legislators to do that. And then since then, we've been working on other bells and whistles. We had a hand in a recent unemployment insurance tax reform that was signed into law last year. And we're always looking out for other suggestions and ideas. There isn't a year that goes by that we don't get some official or legislative leader or even governor from Rhode Island calling and asking for suggestions on how Rhode Island can be more competitive. And I'm always rooting for Rhode Island. A lot of other people, they'll side with Connecticut or Massachusetts or New York or all of that. But Rhode Island's got a lot going for it, and it truly can be an oasis in the Northeast. That's what we're trying to help them do.
Tell us about the Tax Foundation. Give us just a little basic education on that, because I have a feeling, particularly here in what I lovingly refer to as Socialist Workers' Paradise, a lot of people aren't that familiar with the Tax Foundation. But to say that your organization has national clout, it would be an understatement. What are your origins and how it's evolved?
Sure. Well, we're the oldest tax think tank in the United States, and we were founded back in 1937. So next week will be our 80th birthday. And we were founded back at a time of great flux in taxes. So before the Great Depression, before 1937, there was a federal income tax, but it was mostly only paid by the rich. The vast majority of Americans did not pay federal income tax. And And then at the state level, there were no state income taxes, there were no state sales taxes. There was a property tax, of course, and that paid for what state and local government there was, which was primarily schools and courts. In the Great Depression, of course, that changed. You had the states adopt first sales taxes and then income taxes. You had the federal government greatly broaden the federal income tax into the mass tax that everyone pays that we know and love today. So the idea in 1937 by our founders was there ought to be an organization out there monitoring all of this and coming up with best practices and trying to make sure that the tax system that we adopt is studied and analyzed and isn't just the domain of people who love taxes and want to push them forward. So we're described a lot of different ways. People on the right tend to consider us on the left, and people on the left tend to consider us on the right. I think we've got people of all political stripes here, but generally our view is if you're going to have taxes, what's the best way to do it? What's the way to make it as simple, as neutral, and as transparent as possible? Make sure it's not standing in the way of the growth of the economy. And I know that a lot of libertarians, maybe that's not far enough, and we work very closely with organizations in town like the Cato Institute and the Americans for Tax Reform and Tax Policy Center and so forth in order to make sure that all perspectives are presented there. But our main goal is how can we minimize the burdens of the tax system as much as possible using economic principles and just good fiscal common sense.
Now, at the federal level, and we'll get into this in a little bit, but you've got scorecards, you've got the CBO, you've got obviously nationally based organizations like yours analyzing closely issues like revenue neutrality, impact on GDP, unintended side effects. At the state level here, and particularly in Rhode Island, we refer to it as sort of the cliched ready, shoot, aim phenomenon, where very little effort is made to, for example, say something as basic as revenue neutrality. I'll point out an example. We've got a car tax here in the state, and we've got a very expensive automobile sales tax that's minus a lot of the deductions that most states, quote unquote, enjoy in calculating the sales tax on the purchase of automobiles. Effectively then, Rhode Island, and because of some insurance challenges, is one of the most expensive states in the nation in which to own an automobile. When they, after Governor Cherry's second term, as they started to lurch back into the financial collapse du jour, they repealed some of the exemptions. They rolled it back. And the question became, and it hasn't been answered yet, and I'm going back to Governor Cherry's administration, what level of analysis was performed to see if this was even revenue neutral? Say, the high cost of owning a vehicle because of these ancillary taxes, what did that have to do on the collection of sales tax on new purchases that simply didn't occur? That type of analysis doesn't exist here in the state. Is that common across state municipalities? Do you see that kind of same phenomenon?
It unfortunately is very common, and it's, I don't really fault people for it. Rhode Island, you've got some really dedicated legislators. You've had maybe more mixed governors, but certainly ones that we've had good conversations with, and certainly a lot of people who work in public policy in Rhode Island who are trying to do the right thing. But just the nature of state government is that you tend to look at the evidence inside the borders of the state and not really look beyond it. And that's pretty common across the country there. So we exist at the Tax Foundation as a resource to be able to answer the question, what are other states doing on this? What has been tried in the past in other states and worked and didn't work? How do we compare? How do we rank? So we put out a lot of different ranking reports, over 80 different reports a year. We have an app, it's called Facts and Figures, that people can download for free that compares all the states on different tax measures. We put out a number of different studies, ranking studies. The most well-known is our State Business Tax Climate Index, which ranks the states 1 to 50 on their tax system and how competitive it is. And then we do diagnostics where, if a legislator were to call and say, what is the story with car taxes in different states, and how do we compare? We put that together. I do want to emphasize we're a nonprofit, We have no endowment. We get no government money. We wouldn't take it if it was given to us. We want to be independent, and our goal is to just put out good research. It's a classic, what an economist would call public good. We're out here putting out information that, and everything we produce is free on our website. There's no, you don't have to subscribe, or there's no firewalls or anything. And we're aiming for an American public that's better educated about what common sense tax policy is, and to make sure legislators have all the information they need when they make policy decisions.
There seems to be a trend among states. You know, it's funny, it's almost cyclical, and you guys have been doing this long enough. You've probably seen the same trends come, go, repeat themselves, sort of like bad bell bottoms and and tie-dye. It seems like
I haven't seen those come back yet, but maybe soon. You know, I think we're still in maybe an early 60s nostalgia period right now.
Okay. The millionaire's tax.
Yeah.
That despite, you know, and I'll use New Jersey as an example. A few years back, New Jersey, ironically, when I believe the governor was a former, was it a Goldman Sachs executive who became governor? The instituted a millionaire's tax because that was very politically palatable from the Eat the Rich crowd. And the impact was stunning, although not quite what it was intended, because, as I think you and I are aware, people with a lot of money have options. They're not stuck like someone like me in a hellish, you know, post-apocalyptic financial nightmare. Sorry, they get to leave. And so, what was the impact from a topside view of the millionaire's tax in New Jersey, and why are people still even thinking about doing it?
Yeah, I mean, these are good questions, and it's something that we've studied, something a lot of people have studied. So, you know, we put out our own studies, and then we do studies of studies. It's important to note that lots of things go into individual and business location decisions. I'm always the first to concede that. I'm not somebody who says every single decision is made only because of tax policy. There's lots of things that go into why people live where they live and work where they work and open businesses where they open them. And those are things like weather, or the proximity of international airports, or the ability to get a sandwich at 3 in the morning, or where there's even one study that looked at where the wife of the CEO wanted to live, and it studied how correlated that was with where the corporation was headquartered. And there was a relationship. So lots of things go into these decisions. Taxes is certainly part of it. There's lots of studies that show the connection between taxes and those decisions. And I'd also say it's one of the things that a state can control completely. Can't really do much about the weather. You know, Rhode Island, you know, the weather is a given. There's not much state policy you can do to change that. And international airports, you know, that would be very difficult to do. Education is very important, but you probably have to wait a generation to see the results of a particular policy change in that. Taxes, you can make or break the state pretty much instantaneously. And, you know, it would take time to see the results of that, one way or the other, but it would certainly change the way people look at the state. And the millionaire's tax, I would put as one of those topics. You're not going to see assuming it's not like 100% or something, you're not going to see an exodus of people, but what you will see is the calculus that people make would change. So when people settle down to, you know what, I could do this in Massachusetts, or I could do this in Connecticut, or I could do this in Rhode Island, the millionaire's tax puts the thumb on the scale and steers people away from Rhode Island. Because if people are like, well, you know, the states are equal in this, and they're equal in this, and they're equal in this, oh, but Rhode Island's got that, so I'm not going to do it. And that's certainly been the case in New Jersey. There has been some evidence that when they had their millionaire's tax, they don't have one right now, that certainly did have a marginal effect. And it's really hard to do these studies because states tend to put these in bad economic times. So the last flurry of them at the state level was in the 2008 to 2011 recession. And, you know, you kind of have to sort out through that noise because there's a lot of other economic circumstances happening. And you don't want to attribute stuff related to that to the millionaire's tax. And there's a lot of sophisticated economic modeling that goes into it, and economists argue about the right way and the wrong way to do those things. But there certainly is an impact. It's not huge, but I think it grows over time as people gear away from a state, so to speak.
And
I'd also, as one example, over in Washington State, which not only does not have a millionaire's tax, they don't have an income tax, which strikes people as strange because Washington's not exactly the reddest state in the union. It's a fairly liberal state. It has 2 liberal senators. It's voted for the Democratic nominee for president a number of times. But this is a state that does not want an income tax. And not too long ago, just during this last recession, they actually bucked the trend on millionaire's taxes. There was a ballot initiative to impose an income tax that would only apply to about the top 2% of the population income level, just very, very wealthy people. But people voted against it, and by a majority, and it failed at the ballot. And I think part of that was Americans don't see millionaires generally as this other people. They see themselves in the future. Americans are very optimistic like that. I think Tocqueville said that, that Americans are a homeless or a poor American is just someone who's rich but hasn't yet achieved that in his own mind. So I think generally policymakers pushing those proposals have a very tough uphill fight, both in terms of the economic results they're expecting and in terms of the public support that they're seeking. These kind of things pull very well, but they have a very mixed record when they're actually in effect.
Right. And that brings up a critical point. In this age where seemingly every failed state, every failed city is desperate to get on the latest Shelbyville idea, that would be the Amazon HQ2.
Yeah, the Onion has the Onion, the satirical newspaper, has a very good headline of Philadelphia preemptively demolishing their center city in the hopes that Amazon will fix them. And it's not like everything the Onion does. It's not that far from the truth.
No, there's absolutely an element there. But if you could explain to folks what we mean by the effective tax rate. Corporations spend an inordinate amount of time when planning anything from acquisitions to ongoing capital investments to something called the effective tax rate. And that plays a larger than life role in these type of decisions, doesn't it?
Well, let's take as an example the tax debate, the tax bill being debated right now. And one of the provisions is to lower the corporate tax rate from 35% to 20%. That's the U.S. tax on corporate profits. Now, there's kind of a Keynesian way you can look at this, to use one economic school, and then there's, it's just kind of another way to look at it, I guess, the effective tax rate analysis. The Keynesian analysis is, all right, how much revenue will this lose from the federal government? And it's, something like, I don't have the number in front of me, but let's say it's $1 trillion over 10 years. So we're going to, quote unquote, give $1 trillion to U.S. corporations, and what will they do with it? Well, some of it they will give to their shareholders. So anybody who owns stock in the United States, and that includes very rich people. It also includes public employee pensions, and it includes 401ks, and it includes financial institutions. Okay, so they'll all get a windfall, and they'll do stuff with it. Some maybe workers will get a share of it. Maybe they'll get some increased wages. Maybe they'll hire a few more people. Maybe they'll lower prices on some products or put out improvements to products that won't lower the actual price, but will mean we get more for our dollar when we buy things. And all of those things have indirect effects, and they all bleed into the economy. This is kind of the trickle-down critique of tax cuts, because when you add it all up, it's not much more than the $1 trillion that you put out there. So that's one kind of way of analyzing tax cuts. I think it's incomplete, and we at the Tax Foundation think it's incomplete. The other way to look at it is, well, how does this change the incentives for investment? And that's, so right now, when you invest, if you're a corporation and you decide, we're going to buy a piece of equipment, and that piece of equipment is going to make the cost of producing stuff easier. It's going to allow us to better use the labor that we have for more productive purposes, and it's going to allow us to turn out, X more widgets an hour that we can then sell that people will like and make people's lives better. Right now, the kind of the analysis analysis you do on it is, all right, so the piece of equipment we'll buy, right now we have to purchase it all in year one. Maybe we'll borrow to buy it. Maybe we'll take it out of current earnings. And then we can only deduct, we have to deduct it over 5 years, say. And that's a pretty common feature in law. So let's say this new piece of equipment costs $1 million. We can only deduct $200,000 of it from our taxes in year one, and then on the other $800,000 money that $800,000 that we spent buying this piece of equipment, we can't deduct that this year, and we actually have to pay a 35% tax on that amount. So what the tax bill does is it changes it to expensing, where you get to deduct the full $1 million in that first year, and then on any of your profits, that is stuff you didn't spend money buying equipment on, then you pay 20%. So it completely changes the calculus, because now it's like, well, we could buy this piece of equipment, but we have to pay more tax than we're paying right now, and it would, carry over for 5 years, so I don't know whether we would do it, so maybe we just don't do it, and we just hang on and do the best we can right now. Whereas now there's a strong, it takes away the disincentive to invest capital and to use your retained earnings. Right now we have a tax system that really encourages borrowing and postponing rather than investing and improving. And so that's just one example, because right now the numbers don't add up for a lot of companies to be able to do this. They'll move stuff offshore, they won't do it. This really changes the calculus completely. And we got a world awash in cash trying to find a safe harbor. Europe's no good, they're having a lot of economic problems. China, it's a mixed bag. You never know what the next couple of years, whether they have social upheaval down the street or not. The Middle East, I'd say there's the same concern. South America, you got a lot of countries where, how safe really is your money in some of these countries. So the United States has ended up being a safe harbor for a lot of the world's capital. And kind of one of the ideas behind this bill is let's put it to use and see what we can do with it.
Right. I mean, ultimately, the presence of an income tax is the ultimate disincentive to business issue planning, isn't it? I mean, the income tax, and I'll use an example, probably not a good one because their economy isn't the most efficient in the world, but in a tax-free economy like, say, some of the Caribbean islands, where you've got value-added taxes as opposed to an income tax, less thought is given to planning the tax implications, if you will, in a pure world, and more thought is given to what makes sense as a business, doesn't it?
Yeah, I think don't take my word for it. The OECD, which is this organization in Paris, they're a collection of every industrialized country in the world, and they just study everything related to economic issues, and they put out studies. And they did a study a couple of years ago, essentially ranking taxes on how harmful they are to economic growth and improvements in living standards. And they said the corporate income tax is the worst of all the different tax types, because corporations don't actually pay taxes. It's
right.
Passed forward in some form to the workers, the shareholders, or the employees, the customers, and that deters a lot of economic behavior. Next, they had individual income taxes for some of the reasons that you explained there. It's certainly at very high rates. We've had historical examples in the United States of how problematic those taxes could be. One of my favorite presidents is Harry Truman, who was president back in the 1940s and early 1950s. And he had not been a wealthy man or anything. He had basically been a lifetime politician. He had some failed businesses before he went into he was a senator before he was vice president and then president. And so when he retired, he did not really have a nest egg. He actually pretty much went into poverty, and that's why we enacted a pension for former presidents. It was primarily because we didn't want to see a former president essentially rendered poverty-stricken. Nowadays presidents make speeches and they do all this other stuff, and that just wasn't the practice back then. But Harry Truman, he wrote some memoirs. He was one of the first ex-presidents to write memoirs. And unfortunately, he wrote the contract in a way that he got his advance all in 1 year. And this was at a time where the top U.S. income tax rate was 91%.
Oh.
And I mean, it was just a huge problem for them. So, people learned from that experience, so they started structuring their payments over several years so that you wouldn't be in that 91% tax rate in 1 year, and all these other shenanigans. And this is what causes the complexity of the income tax code, because it's almost a game of whack-a-mole. I think is the best way to describe it, because as soon as you close one, you open up another, and that's just the nature of the income tax code. Just to finish up, the OECD also found sales taxes and property taxes some of the least harmful. They did look at everything, so they put those a little bit better for economic growth than income taxes.
Folks, if you're just joining us right now, we have the privilege of having the Executive Vice President of the Tax Foundation, a roughly almost 100-year-old organization, or 80 or something year old organization dedicated to the analysis, the study, the apolitical considerations involved in our, well, at this point in time, complicated tax system here in the United States, both on a federal, state, local, and municipal level. And that is Joseph Bishop-Henchman. Full disclosure, I got to know Joseph through libertarian circles. Full disclosure, I am the chairman of the Rhode Island Libertarian Party, hence my embrace of the analysis, taxation is theft. Folks, if you're also just joining us for the first time, we have the privilege in this section of being sponsored by Beacon Shipping and Logistics. Now imagine, if you will, here in Rhode Island, a company with both a national and international reach focusing on auto transportation. 1-855-3-SHIP-IT, beaconshippinglogistics.com, whether it be that automobile that you buy online, whether it be Aunt Sally's car that you want to transfer out to the West Coast where your child's going to university, whether it be that car you found on eBay Auto. Regardless, a local firm with international connections, beaconshippinglogistics.com. And as always, we point out that supporting local media is an exercise in love, if you will, for the local community. These are folks who are willing to take the chance and on supporting, well, programming that might be a little bit more in depth, a little bit more controversial. They deserve your support. Please take the time to give it to that. Joseph, let's get to the issue at hand then, the Trumpian tax cuts. Now, I had been doing a lot of reading over this for the last few days, and it would appear that in a matter of mere hours, much of what I've read can be effectively thrown out, because this is the ultimate sausage making that's taking place, as we say here in Rhode Island. There are considerations, negotiations, facilitations taking place even as we speak, which may render a part of this conversation, I don't know, moot in just a few points. Let's first start from the very beginning. And if you're listening for their show for the first time, we're not big here on handicapping elections, handicapping political bills, obsessing like so much of the American media does over whether it'll pass and the drama of who will vote for it and who won't. We're focused really on the underlying issues and trying to explain or get a cogent analysis from thought leaders like Mr. Bishop-Henchman as what's actually the underlying concepts in here. So the first thing I've got to ask is, this is being marketed as the Trump tax cut. Is it, and I've got to point out the not so subtle irony of earlier this day. We were treated, if you're in the bubble and you're watching every minute, as some of us are, Senator Chuck Schumer of New York actually had the temerity, the sheer gall, the nerve, in one of the perhaps the most jaw-dropping moments in my lifetime of following politics, of standing out on a podium in front of the major media and complaining about the deficit. Wow, that's how far we've come. That's why we know we're not in Kansas anymore. Think about that for a few minutes. But Joe, is this really a tax cut? That's the first question.
It is, and well, I guess it might be helpful to talk about why this bill, why has it led up to it, what's been happening, and I'd say it's three reasons primarily. One is that we have very high tax rates, both on individuals and on corporations. If you look internationally, the U.S. corporate income tax rate is now the highest in the industrialized world. Japan has cut their rate below ours. France has cut their rate below ours. Canada has cut their rate almost less than half of ours. We just have a very high tax rate. We have a very complex international tax system. We're one of the few countries in the world with a worldwide tax, where we tax Americans wherever they are. So if we've got an American company in Germany, they're paying German taxes and U.S. German companies just paying German taxes. It puts us at a competitive disadvantage. It's just a very badly designed system. It's also very complex and confusing for a lot of people. The commissioner of the IRS, who I've had the pleasure of both having lunch with and suing, says that he himself doesn't do his own taxes. He hires a paid preparer. Majority of Americans hire a paid preparer to do their taxes. The tax code is longer, as I tell different audiences, than both the Bible and the Harry Potter series. There is, and I say this as a tax expert, there is no one American who understands the tax code. It is impossible because it's not only the laws, it's also the regulations the IRS issues, the court decisions issued by the tax court, and the interpretive gloss. The kind of practitioner's understanding of what you can get away with and what you can't, and what these things really mean. And that's a big problem because Americans look at this and they see, well, most rich people are paying a lot, but some are paying nothing. And most poor people are paying nothing, but some are paying a lot. And it almost seems arbitrary. And there's plenty of examples of somebody who's well-connected or somebody who's in the know being able to kind of somehow get away with not paying anything or not paying enough. And that just strikes a lot of people, including myself, as wrong. So that's kind of the background of the debate of, okay, we need to do something about this system. So that kind of defines the problem. Now let's talk about whether what we're debating right now is close to a solution. There's a couple different provisions of the Senate bill that's being debated right now, and that looks like it's going to be the main vehicle if they end up passing it today. They fix that international aspect. So instead of the worldwide tax system of multiple taxation, we just switch to what's called the territorial tax system, like every other industrialized world. So it kind of fixes the competitiveness problem there. On the rate, it lowers the rate from 35% to 20%, we think. So maybe there might be an amendment on that.
Right.
That's kind of been one of the issues of the last 24 hours. Because the nature of the Senate, you need 50 or 51 votes to pass it, 50 votes if you send the vice president in to break a tie. I think they've got about 47 or 48 senators locked down, and that gives the last couple a lot of leverage. And so we'll see what the final deals are there. It adopts the idea known as full expensing, which is where if you buy a piece of equipment, you can deduct the full amount in the year that you purchase it rather than having to spread it out over several years, which is the current practice of our law. And that has big pro-growth impacts. It also aligns tax law with economic reality. Because, if you spend $1 million to buy a piece of equipment, you don't have that $1 million anymore. So it's kind of weird that you have to continue paying tax on it as if you continue to have it. So those are some of the good aspects of the bill. There are some bad aspects. In order to kind of fit within this arcane Senate budget rule, which I'll spare you the details on unless you really want to know them, a lot of the individual provisions of the bill expire. So to the extent there are tax cuts, and for individuals, a lot of them end after 6 years. The idea being, well, 6 years from now, the Senate of the future will vote to extend them. So they're not really going to expire, but for budget reasons, we're going to assume they do. That means that the bill does have about $1 trillion worth of tax cuts, but it also drives up the deficit by that same amount. So all told, if you were to look at the bill, it's got about $6 trillion worth of tax cuts, about $4.5 trillion of loophole closings and tax increases, and that net leftover is a negative $1.5 trillion number. Big negative that a lot of people have flagged, which I actually think is a positive, so maybe we can argue about it, but is the removal of some individual deductions, especially the state and local tax deductions. So right now, about a third of Americans deduct their state taxes from their federal taxes. It's a big savings, and that deduction would go away under the Senate bill, although it looks like there may be a compromise to put property taxes back in. So you wouldn't be able to deduct your state income taxes anymore, but you would be able to deduct your property taxes.
Right.
There's a whole bunch of other deductions that go away as part of a general cleanup of the code. A lot of them are very popular with people who take them, of course, so they're very upset. So that's kind of the gist of what's in the bill right now. So your question was, is tax cut, it's looking like it's going to be.
Now,
For most people, not all though.
right. Now, what's interesting, the political implications of this are astounding. Of course, there are broad accusations from typically blue states, New York, Massachusetts, California, who are pointing out that the federal the income tax deduction, the state and local income taxes, is politically motivated, a shot against the broadside there because they're effectively high tax rate. In one analysis on NPR today, talking about how then they would have to lower the amount of government because all of a sudden they wouldn't have as much money because people would be forced into situations where their disposable income would be compromised by this. As a libertarian, of course, that's music to my ears, but it's interesting how, since local tax laws have been allowed to run amok and are their own sort of Byzantine nightmare, how they've effectively used federal taxes to subsidize their operations. And as we pointed out a couple times tonight on this show a few weeks ago, a gentleman from the 1889 Institute working under the Goldwater Institute did a fascinating study on the impact of taxation on current methods of calculating GDP on a state-by-state level. By the way, I once took a week-long course in Subpart F income analysis, so I do find this stuff interesting in earlier life.
I've written a paper on Subpart B, Subpart F myself. I wouldn't say it's one of our most popular papers, but for somebody who really wants just kind of I use Starbucks as an example in it, so try to do my best to try to make it relatable. That's the goal of us at the Tax Foundation, to take taxes and do our best to explain them in a way that lay people can understand, because it is important. It's our money and it's being spent, and people should be able to know how it works.
Right. Now, under this, now the 20% is often described as the line in the sand, but I believe it's Mr. Corker, who's famously done a great deal of battle with Mr. Trump recently, is advocating for some type of trigger mechanism, even during that period, should deficits rise or the expected level of economic activity not take place. And you've got people like Susan Collins who are arguing for a $10,000 property tax deduction because of the issues surrounding home building and all that. If this continued nitpicking, at what point do you say, Uncle? Because, for example, in our level here in Rhode Island, where academia is such an important, quite frankly, industry here in the state, the notion that so many of these different stipends and graduate student pay and things like that would all of a sudden become taxable is very challenging here locally. Is it time that we step beyond this type of piecemeal back and forth, broad cuts matched by this war of attrition during the sausage making, or is it time to really redefine how we tax to begin with? Is something like this capable of being successful?
Those are very good questions. And Harry Brown, who was a politician back in the 1990s that I very much admired, he framed tax reform. I mean, I still use what he said about the concept of tax reform. And that's, would you be willing to give up your favorite deduction in return for a lower tax bill overall? Because, you pick an American and they've got a deduction they prize in the tax code. And
Correct.
We've heard, you've mentioned quite a few of them all there. And the whole idea behind the concept of tax reform is you broaden the base, take out all of those deductions, and you reuse the revenue to lower the rate overall. And that's what Rhode Island was able to do with its income tax rate reduction a couple of years ago. Mm-hmm. The federal tax bill, being a federal tax bill, is not perfect at this. There's a lot of deductions that remain, and then rates don't go down perhaps as far as they could. But that's the trade-offs that you have to make on any federal proposal. I don't know. I guess I'm often called a squish because I'll take a quarter of a loaf or half a loaf if it's a net positive change, even if it's not 100% of the way. And I think that's a lot of the debates being had right now over this gets the 20% rate and it gets the expensing and it gets the territorial. Is that worth giving up, and it doubles the standard deduction for all taxpayers, is that worth giving up the state and local deduction? Is that worth giving up something else that I take advantage of. I will say, just as one clarification, the tuition thing for the grad students, that was in the House bill. It's not in the Senate bill, and it's not expected to be in the final bill.
Interesting. Okay, and again, like you say, not only all politics are local now, all taxes are very local now, and that remains the single biggest challenge to this sort of sea change that we so desperately need in this nation, because it's become so balkanized, the tax system. What about dividend repatriation? That's an issue that's been talked about a great deal. There was a famous interview with on 60 Minutes where one of the hosts, Leslie Stahl, I think, was gobsmacked, if I can use that term, by the notion of how much money was sitting overseas in bank accounts waiting to be brought here. Is that being addressed?
It is. So right now, under our tax system, as I said, there's a strong incentive to push your money and your operations overseas. And companies, I don't want to speak for all companies. Some of them are bad, some of them are good. But a lot of them would really like to bring that money into the United States and spend it investing here. Because, like I said, we're the safe haven for money. Mm-hmm. You generally don't want to leave your money in countries overseas, because you're not going to get as good a return as you do here in the United States. But our tax system deters that, because you have to pay the foreign tax, and then you have to pay an additional 35% tax when you bring it back to the United States. And sometimes that's just worse than just leaving it sitting in a bank account or invested in property in Paris or wherever it happens to be. Right now it's about $2.5 trillion. I think 2.4 is the most recent number. Which is a kind of an enormous, unfathomable amount of money. The big change in this tax bill is it switches to a territorial system. So we actually stop taxing that money. We're not going to tax you when you have overseas operations. We tax you when you do stuff in the United States, which is the same way Germany taxes, the same way Canada taxes, the same way the United Kingdom taxes, pretty much every industrialized country. And then there's a transition rule. So on that money that has built up overseas, we're going to impose a one-time tax. It's looking today that it will be about 14% on cash and 7% on investments that you've made. Again, those numbers may change, but it's looking like that number got upped a little bit in some of the negotiations today. But that's a one-time tax, and once you pay it, you're done with your tax burden on that money. People on the left, they're calling that a tax giveaway, because of course they want the full 35%, even though that money will essentially never be collected. And then imagine there's people on the right who think it's highway robbery, and that we shouldn't be imposing this one-time huge tax on money that's not brought back. So they've kind of found a middle ground on that, and then going forward, we're not going to have this system where we essentially have built a wall around the United States preventing investment to come back in.
Mm-hmm, mm-hmm. The estate tax, the death tax, much is being made in terms of political chatter on that. Where does that stand right now? As far as
and there's a difference between the two bills on that. So it'll be interesting to see. The House has passed a version that eliminates the estate tax. The Senate, as far as I can tell, there's not enough votes interested in eliminating the estate tax in the Senate bill. So there is instead a proposal to double the exemption amount. Right now, the first 10 million or so of the states are exempt from the estate tax. Mm-hmm. This would double that amount. I think that'll be a potential conflict between the two houses. So we'll see how much the House of Representatives cares about that provision, whether they just go along with the Senate one, or they think they can push the Senate to kind of come over to their side. I think at the end of the day, you'll end up with the Senate version, and we'll continue to have this issue. And it's a divisive one politically. There's a lot of people who are like, look, I've paid my income taxes, I've paid my sales taxes, I've paid my payroll taxes, I paid my dividend taxes and capital gains taxes, and now when I die, you want me to pay an estate tax too. It's just not right. It's too much. And then on the other side, you've got kind of the Bernie Sanders types that are talking about the accumulation of wealth with very high income individuals, and how the estate tax is a tool for preventing that. I personally don't think it's a very effective tool at that. Most rich people are very effectively plan their way out of the estate tax. But I guess it's kind of a symbolic thing now. It's nothing in the federal budget. It's a couple $1 billion, a couple, I think, tens of billions of dollars a year, which in the context of a $3 trillion budget is not much. So it's almost symbolic at this point for both sides, although it certainly hits a lot of people and has a lot of compliance costs. Because if you're any type of person with a couple $1 million in assets, you've got to hire a lawyer and come up with an estate plan.
Right, and my concern about the estate tax has always been with the folks in the middle, the family-owned business or the closely owned business that might have a market value somewhere in the $5 to $10 to $15 million. Quite frankly, look at our most recent presidential candidate from the Libertarian Party, Gary Johnson, was largely a self-made man. At university, he started effectively what people call mechanical or an HVAC business. What was it? It was Big J Enterprises or something to that effect, and which grew into a company that was, even though he sold it to run for governor, until very recently, and it technically still exists as a division of another company, but until very recently, it employed over 1,000 people and was still in business. A testament to his business skills. But businesses like that are very often forced into some type of fire sale because, quite frankly, even if there is a will and there is a succession plan, all of that's been calculated, there very often is a strong tax calculation involved in the ability of families to maintain those mid-level businesses. I'm not talking about the Warren Buffetts of the world. I'm talking about the guy who's got a business that he might be generational, that's built up all of a sudden into a $20 or $30 million business, employs hundreds of people very successfully, is a fabric of very many communities, and is forced into some very difficult decisions. The same thing is true of family farms. They're facing enough competition with the corporate, farming in America. These are people who want to maintain their structure, but are forced again into difficult decisions. And that's been my objection, if you will, to so many years because of this, because of the nature of the bill.
Right. I mean, people say, millionaires tax and estate tax. You kind of picture like Paris Hilton, drinking and being irresponsible.
Mm-hmm.
But 80% of businesses in the United States don't pay through the corporate income tax. They pay through the individual income tax.
Mm-hmm.
And as you said, it doesn't take a lot to end up being a quote-unquote millionaire just on the basis of having a very successful business in operation. Here in D.C., you mentioned the estate tax. D.C., we used to have our exemption until not that long ago was a couple $1 million from the estate tax. And if you live here in D.C. and you've lived here for 30 or 40 years and you bought a house a long time ago and you've got a good successful small business, the run-up in real estate prices here, kind of around you as you live here for a long time could easily push you over that threshold. And then we're doing what nobody wants to do, which is forcing small businesses and long-time residents who are very invested in the community to liquidate their assets and divest and sell out to newcomers because of a badly structured tax.
Right. So I guess, and again, I'm so grateful that you were able to spend the evening with us. Again, on arguably what's going to be one of the busiest weekends, or as we go into this week, and as I say, around here we call it the sausage making. To truly
I will say, if you've got any supporters or donors of the Tax Foundation listening, let me reassure them that we are all on about maybe 4 or 5 hours of sleep at night.
Mm-hmm.
You're getting very good bang for your buck this week. We're monitoring everything. We're making sure that any tax questions out there are getting answered, and we're certainly being utilized quite a bit. Name a senator. We have talked to that senator's staff in the last 5 days.
Excellent. So I guess two things in closing, and this is the $1 trillion question, if you will. Based on your analysis, and this is almost unanswerable, because again, it's still in transition, but the $1 trillion issue seems to be that, is this voodoo economics? Is this trickle down? Will this result in substantial economic growth that will in time make that $1 trillion additional deficit, as it's been calculated by some, go away? Or is this just a gift to the millionaires and to the money classes in this state, in this country, or is it somewhere in between? I mean, what's the big takeaway right now on this tax cut?
I'd say it's somewhere in between. Now, we haven't been able to complete a full analysis of the current proposal. It's just moved too quickly, and the details are still coming out even today. So it's been difficult for us to do. We did do an analysis 2 weeks ago of the original Senate proposal before it was amended. And we found that the total cost over 10 years, DC does everything over 10 years. I don't know why that is. Everyone else does it, on an annual budget. For DC, we do it over 10 years. Over the next 10 years, it'll reduce federal revenues by about $2 trillion. It'll get back about $1 trillion of it from economic growth. And then it'll also avoid the need for about $500 billion in annual tax cuts that the Senate waits until the last minute, whether they're going to renew or not. It's kind of full employment for lobbyists because everyone's job is to make sure that this annual bill gets passed every year. That won't be necessary anymore, so that's kind of another $500 billion. It doesn't pay for itself. It doesn't close the gap completely. If that's your concern, it's not quite there yet. It does boost the GDP. It does grow jobs. It does kind of unlock a lot of capital and set us up for better long-term growth. So if that's what you're concerned about, I think it's a good bill. I'm asked all the time, what do you think of the bill? How do you rate it? How do you rate it? What do you think of it? And my answer has been 3 out of 5 stars. I think there's things that could have been added. I think there's stuff that's in it that I don't necessarily like, but at the beginning of the year, we were like, what would be great in a federal tax bill? It would be great if the federal tax bill was permanent. Well, it's got a lot of temporary stuff in it. It would be great if a bill had full expensing and territorial. It's got both of those things. Full expensing, Senator Flake of Arizona, again, another senator that I personally really admire a lot. He managed to actually make that a provision a little bit better today as a condition of him voting for the bill. And then, it'd be really nice if the bill had a competitive rate, and this certainly does that too. There's some provisions I don't like, which kind of narrows it down a bit, and then the deficit is pretty high. But, put it into context, the federal government is already planning on running a $10 trillion deficit over the next 10 years. And that's out of, about $30 to $40 trillion of revenue and spending. So, Senator Corker truly is concerned about the deficit. I think there's a possibility to make that up on the spending side. Revenue as a percent of GDP right now it's already above its historical average after World War II. So I think we historically are in line for a tax cut. Spending is significantly above the post-war average. We're actually spending more as a percent of our GDP now than at the height of the Vietnam War, at the height of the Korean War. I think there's room for avenue on that. That can't be done as part of this tax bill for Senate rules reasons. And we'll see if the deficit hawks who are decrying the debt we're going to run up on this bill are still around a week from now when they start debating the budget for the federal government, whether they decide to close some spending programs there. I'm not holding my breath on that.
Well, again, the spectacle of Chuck Schumer shedding tears about the size of the deficit was one of the more astonishing moments and that I've seen recently in politics. Just how can folks support and find and read more about the Tax Foundation? Because we've formed close alliances over the last year or two with folks like Fire and Goldwater and 1889. Going through your site, there's an astonishing amount of truth there. It's mostly apolitical. It's based on numbers. It's based on real economics. There's a focus there on accessibility to the average person like myself that is sorely lacking in government because of their willingness to make things complex, and it's sorely lacking from the major political parties because of their desire to obfuscate in behalf of politics that are favorable to their own self-interest. So how can folks find out more about the Tax Foundation, and how can they contribute?
Well, I appreciate those compliments, and that is what we aspire to. We want to, we have a goal of achieving a tax code that's simpler and is more pro-growth and doesn't stand in the way of individual and business decisions. but we also want to make sure that we're credible and that we're advancing policy. And so that's why you see that kind of tone and perspective, where it's very factual and it's very informative, and that is what we try to do. Certainly check out our website at taxfoundation.org. We've got a newsletter where you can follow everything that's happening in the United States, either by state or by particular issue. And then we accept contributions on our website. They are tax deductible to the fullest extent of the law, as we're a nonprofit organization, and we depend entirely on them. We have about 2,600 donors nationwide. If it wasn't for them, we wouldn't be able to do anything that we do. So we're certainly very grateful for anyone offering to support. And some of the organizations you mentioned, we certainly work with on any issue overlap that we can find. We try to work with everybody, and that's why almost unique among organizations that some characterize as libertarian, we're able to work just as much with Democrats as we are with Republicans all across the country.
Wow, outstanding. Joseph Bishop-Henchman, he is the Executive Vice President of the Tax Foundation. He, as I mentioned in the run-up to the show, he's been involved and quoted in just about every major publication, every Talking Head show imaginable, and we were so grateful that you found the time tonight and possibly one of the busiest weeks, perhaps of your career, to join us tonight on the Coalition Radio. Thank you so much, and I look forward to. I hope I get a chance to finally meet you at some point in the future. I don't know if you're going to be spending time in New Orleans this summer. There's an event coming up.
I'll be there.
You'll be there. Well, then I owe you the proverbial beer/coffee/beverage. So we can toast to this madness. Thank you so much for joining us. We're simply better for having you spend time here today. So thank you very much.
My pleasure, and thank you for everything you and your listeners do. It's important. We need a better informed public, and I think there's a lot of work that still needs to be done.
Great. Folks, we are the Coalition, loud and proud, outrage porn-free, civilly disobedient media, broadcasting live on the worldwide Coalition Media Network, here at the Go Local Live Broadcast Center, 90 Way Boston Street, in the heart of the city we love, Providence, Rhode Island, the naked city, the city of 1,000 stories. We told a few tonight, some local, some national, all of which, however, will have profound impact on your day-to-day life, both as citizens of Rhode Island, citizens of the United States of America, and the world around us. Like it or not, we are a global community. How we trade and how we move forward. CoalitionRadio.us, Facebook.com/The Coalition Radio, and on the mighty Twitter at Coalition_Radio. Stay tuned. Coming up, we've got some folks from Reason Magazine. We tackled it all tonight, starting from a range of social and fiscal issues here at the state to the ongoing tax litigation and legislation, I should say, on the national level. Now, we're going to talk about net neutrality. Stay tuned. We'll be right back.